For years, they told you it was a fraud, a pet rock. But behind the scenes, the world's biggest banks have been quietly building the tools to take over. This isn't some conspiracy theory, it's a calculated strategy, and it's already unfolding. They aren't just dipping their toes in the water anymore, they're building the ships, charting the course, and getting ready to own the entire ocean. What we're witnessing is the start of a hostile takeover, all dressed up in the language of innovation and adoption. You've been sold a story that Wall Street is finally getting it, that institutional adoption is the ultimate sign of a bull market. But what if the reality is far more complex and a lot more threatening to the whole idea of decentralization? What if the titans of traditional finance aren't joining the crypto revolution, but co opting it? What if they're just assimilating it into the very system it was supposed to replace? Today, we're pulling back the curtain. We're going to break down the playbook being used by giants like JPMorgan Chase. This goes way beyond just buying Bitcoin ETFs. This is about controlling the very rails of the new financial system. We'll connect the dots between what they say in public and what they're building in private. This is the story of how banks are secretly, methodically, and brilliantly taking over crypto. And it all starts with the one man who has been crypto's most vocal and perhaps most hypocritical public enemy. To get the sheer scale of this strategic pivot, you have to go back to the beginning. You have to listen to the words of the king of Wall Street himself, JP Morgan Chase CEO Jamie Dimon. For the better part of a decade, Dimon has been the lead villain in crypto's drama. His quotes are legendary, a masterclass in institutional shade. Let's take a quick trip down memory lane. It's November 2015. Bitcoin is trading for around 400 bucks, and Dimon is calling for a government crackdown. He states, "No government will ever support a virtual currency that goes around borders and doesn't have the same controls. It's not going to happen." He was drawing a line in the sand. Money is for governments and banks, and this digital pretender wasn't invited to the party. 2 years later, in September 2017, he took it to another level. At a banking conference, he dropped the bombshell that would define his stance for years. He called Bitcoin a fraud. It wasn't just a bad investment, it was a straight up scam. He even declared he would fire any JP Morgan trader in a second for trading it. Why? For two reasons: it's against our rules and they're stupid. The hits just kept coming. In October 2017, he warned, "If you're stupid enough to buy it, you'll pay the price for it one day." By 2021, even with the market soaring, he didn't budge, telling the world Bitcoin has no intrinsic value and that regulators are going to regulate the hell out of it. He called it fool's gold. And then, in his most dismissive jab of all, he compared the world's first decentralized digital asset to a pet rock. For any normal person, the message was loud and clear. JP Morgan, the biggest bank in the US, saw crypto as a worthless fad destined for the history books. But here's the twist, the part of the story that doesn't make the headlines. While Jamie Dimon was publicly trashing Bitcoin, his bank was quietly getting to work. Even as Dimon was calling Bitcoin a fraud in 2017, JP Morgan was building out its own blockchain platform, which would later become Onyx. He was playing a brilliant game of misdirection. He famously said, "God bless the blockchain," separating the tech from the assets themselves, a classic move to sound forward thinking while dismissing the actual revolution. This wasn't hypocrisy, it was strategy. Dimon's public war on crypto did something very useful. It cooled down institutional excitement, it planted seeds of doubt among competitors, and it gave his own bank precious time to build its arsenal in the shadows. He wasn't trying to kill crypto, he was trying to slow it down just enough for his empire to catch up and eventually take control. And then the narrative started to shift slowly at first, and then all at once. The tone changed. His bank became an authorized participant for BlackRock's Bitcoin ETF. They started giving overweight ratings to crypto stocks like Coinbase, and Dimon himself, with a tone of frustrated acceptance, finally said he would defend your right to buy Bitcoin. This wasn't a change of heart, it was a change in tactics. The building phase was over, the launch phase was beginning. The years of public ridicule were the perfect cover. Now, with their pieces on the board, it was time to show their hand. And the centerpiece of this whole operation is a project that sounds harmless, but could be a Trojan horse designed to breach the walls of decentralized finance. It's called JPM Coin. JP Morgan's JPM Coin has been live for a few years, quietly processing billions of dollars a day in transactions for its institutional clients. On the surface, it sounds like another boring bank project, but to dismiss it is to fundamentally misunderstand the weapon they are sharpening. JPM Coin is the blueprint for a new kind of financial instrument that could challenge the entire stablecoin ecosystem. So, what is it really? Let's break it down. When you use a stablecoin like USDC, you're essentially buying a token from a non-bank company like Circle. That company takes your dollar and holds it in reserves, mostly in things like short-term government bonds. The token you hold is a promise, an IOU from that company. You're trusting them to manage those reserves properly. Bank-issued deposit tokens, the category JPM Coin belongs to, are entirely different. A deposit token isn't a promise for a dollar held somewhere else. It is the digital representation of a dollar held directly in a deposit account at a bank. It's a direct claim on money sitting inside one of the most regulated financial institutions in the world. This isn't just Bitcoin in a business suit. This is the bank itself becoming a token. And this one distinction creates a game-changing killer feature that today's stablecoins may not be able to legally compete with. A deposit token could pay interest. Let that sink in for a moment, because a deposit token represents actual customer deposits that are already earning yield at the bank. That interest could potentially be passed directly to the token holder Naveen Mallela, who heads JPMorgan's blockchain division. Onyx has been very clear about this advantage, noting that for institutional clients, deposit tokens could offer a compelling, yield-bearing alternative to stablecoins. Current regulations often prevent stablecoins like USDC and UTST from doing this. This single feature could position bank-issued tokens to systematically drain liquidity from the existing stablecoin market. Why would a large trading firm or a corporate treasury park millions in a non-interest-bearing stablecoin with its own risks when they could hold a token that is a direct deposit at JP Morgan and pays them yield? The short answer is they probably wouldn't. This isn't a fair fight. It's a strategic checkmate against the stablecoin ecosystem as we know it. And where has JP Morgan been testing these concepts? Not just on private permissioned bank ledgers. They've been actively experimenting on public blockchains, including Ethereum Layer 2 networks, as part of initiatives like Project Guardian with the Monetary Authority of Singapore. This isn't an accident. It's a declaration of intent. By testing on public blockchains, JP Morgan is deliberately placing its institutional-grade financial weapons onto the same battlefield as DeFi. The audacity of this move is breathtaking. They have the blueprint for a superior financial product backed by the full faith and credit of a too-big-to-fail bank, designed with a feature that competitors may not be able to legally replicate, and they are testing how to deploy it directly into the heart of crypto territory. JPMCoin isn't just a settlement tool. It represents the first soldier out of the Trojan horse. It's designed to look like a gift, a stable, regulated, potentially yield-bearing dollar on-chain. But its true purpose is to establish a beachhead, to become the dominant form of digital cash, and to pave the way for the army following right behind it. The development of JPM Coin isn't happening in a vacuum. It's the most visible part of a much larger multi-stage strategy that JP Morgan and other big banks have been running for years. This isn't a random stumble into the world of digital assets. It's a coordinated campaign to build a new financial system on their own terms. When you connect the dots, the blueprint is alarmingly clear. It's a strategy built on 4 key pillars: tokenize the assets, control the rails, own the on-ramp, and weaponize the collateral. Let's start with the first one: tokenize the assets. JPM Coin is the money, but what are you going to buy with it? Wall Street's goal is to tokenize everything. We're talking stocks, bonds, real estate, carbon credits, fine art, every real-world asset you can think of, turned into a digital token living on a blockchain. Projections from firms like Boston Consulting Group suggest the market for tokenized assets could swell to over $16 trillion within the decade. Why the obsession? Because tokenization is incredibly efficient. Instead of a stock trade taking days to settle through a tangled mess of middlemen, a tokenized stock could settle in seconds, 24/7. But more importantly, whoever controls the platform for tokenizing and trading these assets becomes the new New York Stock Exchange. Banks like HSBC and Citi are already running pilots to tokenize things like gold and private funds. They are in a race to turn the world's wealth into digital tokens that they, the banks, will issue and manage. This brings us to the second and most critical pillar: control the rails. An asset is useless if you can't move it. A financial system is defined by its rails, the infrastructure that moves money. For a century, banks have owned these rails: ACH, SWIFT, Fedwire. They're slow, expensive, and they close on weekends. Blockchain was the first real threat to this monopoly, offering a vision of open, public rails anyone could access. So, what did the banks do? They adopted a brilliant embrace and extend strategy. First, they built their own private permissioned blockchains like JP Morgan's Onyx network, which already handles billions in daily volume. This gives them the efficiency of blockchain without giving up control. But the truly bold move is their push onto public blockchains. JP Morgan's experiments on public networks are a prime example. Why do this? Why step onto crypto's home turf? Because they know they can't keep everything locked in a walled garden forever. So instead, they aim to become the most dominant and trusted application on the public networks. They're building their clean, regulated, institutional superhighways right over the chaotic, decentralized landscape of crypto. Their goal is to make their rails the only ones that matter for serious money, creating a VIP lane on the public highway that will soon carry all the meaningful traffic. Next, the third pillar, own the on-ramp. How does money get into this new tokenized world? Through the banks, of course. For years, getting money into crypto was a fight. Banks would freeze accounts and block transfers. They were hostile gatekeepers. Now they're rebranding themselves as the friendly neighborhood concierges. JP Morgan is now a key banking partner for exchanges like Coinbase and acts as an authorized participant for the big Bitcoin ETFs, meaning they are a primary gateway for institutional money to flow into crypto. Big banks are all building out crypto custody services, a move that was unthinkable just a few years ago. They are systematically positioning themselves as the only legitimate safe on-ramp for any serious capital, whether it's from a corporation, a hedge fund, or a pension fund. If you want to move $1 billion into the digital asset economy, you won't be using a retail app. You'll go through JP Morgan or BNY Mellon. They're no longer fighting the flow of money. They're positioning themselves to take a fee on every dollar that moves in or out. Finally, the fourth pillar, the move that cements their dominance, weaponize the collateral. This is the end game. Once the banks have tokenized the world's assets, control the rails they move on, and own the on-ramps, they move to the most profitable part of banking, lending. And in this new world, tokenized assets are the ultimate collateral. Major banks are already exploring how to accept crypto assets like Bitcoin and Ether as collateral for loans. This is huge. It represents the full integration of crypto into the core banking function of creating credit. But think about what this really means. In today's DeFi world, lending happens peer-to-peer on protocols like Morpho or Aave, governed by transparent smart contracts. In the new Wall Street-controlled world, lending will happen through the banks. They will set the terms, they will control the liquidation mechanisms, and what will they be lending? Their own proprietary interest-bearing deposit tokens. It's a perfectly closed loop. They help you buy the asset, they custody the asset for you, and then they lend against that asset. Every step is a revenue stream, and every step reinforces their central role. The dream of disintermediated finance dies, replaced by a hyper-efficient but still very much intermediated system run by the same players. If you're getting value from this breakdown and starting to see the bigger picture, do me a favor and hit that subscribe button. We're going deep on this topic, and you won't want to miss what's coming next. This isn't FUD, it's a strategic analysis of the biggest shift happening in finance today. So join the community and let's navigate this together. So let's zoom out. What does all of this actually mean for the future of decentralization, for the average investor, and for the very soul of crypto? This convergence of traditional finance, TradFi, and decentralized finance, DeFi, is not a merger of equals. It's the assimilation of a young, revolutionary idea into a centuries-old power structure. The future of finance probably isn't the decentralized utopia that crypto natives first imagined. It's not a world without banks. Instead, it's looking more like a hybrid system, a two-tiered world that borrows the tech from blockchain but keeps the power structure of Wall Street. Think of it this way. The banks are building their own private toll roads on top of the public land of blockchain. JPMCoin and other bank-issued tokens are like the official regulated easy pass that gets you into the fast lane. You can still drive on the old public roads of DeFi with your USDC, but the real money, the institutional assets, and the high-speed trading will all be happening on the bank's superhighways. They won't have to outlaw DeFi. They'll just make it irrelevant by building a shinier, safer-looking alternative right next to it. To be fair, there are two sides to the story. There's a bull case and a bear case for this future. The bull case, the argument you'll hear from the institutions, is that this is just the crypto market growing up. They'll say it's a good thing the flood of institutional money brings legitimacy and stability. The Wild West of DeFi, with all its hacks and failures, will be replaced by a safer, regulated environment. This integration could unlock trillions in liquidity from real-world assets, making the whole financial market more robust. For the average user, this might mean safer products and easier access. This is adoption, plain and simple. But then there's the bear case, the crypto native perspective. This isn't adoption, it's a hostile takeover. This is the classic embrace, extend, and extinguish strategy. Wall Street is embracing blockchain tech, extending its own systems on top of it, and in the process, extinguishing the permissionless, decentralized spirit that made crypto revolutionary in the first place. In this future, decentralization is just a marketing term. Sure, the transactions might be recorded on a public blockchain, but the real points of control, the on ramps, the off ramps, the issuance of money, and the terms of credit remain firmly in the hands of a few powerful institutions. The core idea of peer to peer, trustless finance gets replaced by a new kind of middleman. You're no longer trusting an open source smart contract. You're trusting JP Morgan. You're trusting their private code, their terms of service, and their ability to freeze your funds or blacklist your wallet if a government tells them to. The promise of a censorship resistant system open to all is replaced by a system that's more efficient, but just as permissioned as the old one. This raises some huge questions. What happens to privacy when every major transaction flows through a bank issued token on a public ledger? What happens to financial sovereignty when the keys to the kingdom are held by the same institutions that have always held them? The danger is we end up with a system that has the surveillance power of a government run CBDC, but is operated for the profit of private companies. It could be the worst of both worlds. The revolutionary potential of crypto is being neutered. It's being transformed from a disruptive bottom up movement into a top down enterprise solution that just makes the existing system run better for the people already in charge. It would be a mistake to think this is just a JP Morgan story. While they're clearly the flagship leading the charge, they are just the lead ship in a massive fleet. Almost every major financial institution is moving in lockstep, running a variation of the same playbook. This is an industry wide pivot. They all know blockchain is the future of financial plumbing, and they all want to be the ones who own the pipes. Let's look around the fleet. Citigroup is right there, launching its Citi Token services to turn client deposits into digital tokens for instant global payments. BNY Mellon, America's oldest bank and a giant in asset custody, now safeguards crypto assets right alongside traditional investments for its institutional clients. Across the Atlantic, the European giants are on the move. HSBC has launched a platform for tokenized gold for its clients in Hong Kong. Deutsche Bank is working with the Central Bank of Singapore on asset tokenization trials. And it's not just banks. Even PayPal has its own dollar-pegged stablecoin, showing that the entire financial establishment sees which way the wind is blowing. What we're seeing is a global consensus forming among the financial elite. The era of doubt is over. They know that if they don't build these new rails, someone else will. And this whole movement is getting a huge push from governments and regulators. Far from fighting this takeover, they seem to be enabling it in the US. Proposed legislation like the Clarity for Payment Stablecoins Act tends to create a regulatory framework that is much easier for large, insured banks to comply with than for a small crypto startup. Instead of creating an open playing field, the emerging regulations are building a moat around the existing castles. This regulatory environment is being shaped to favor the dominance of JP Morgan, Citi, and their peers. Proposed rules often include restrictions on stablecoins paying interest, a rule that bank-issued deposit tokens, which are a different legal instrument, could cleverly sidestep. This is the final piece of the puzzle. The banks aren't acting alone. They are moving together with the blessing of regulators who would rather deal with a few large compliant institutions than a decentralized world of thousands of anonymous developers. The takeover isn't just a corporate strategy, it's becoming sanctioned policy. The Armada is sailing, and it has the full backing of the Admiralty. So, where does this all leave us? The evidence is pretty overwhelming. The story that banks are simply adopting crypto is a nice, simple fiction. The reality is far more strategic. What we're witnessing is a methodical campaign by the titans of finance to co opt the blockchain revolution and remake it in their own image. It's a strategy that began with years of public ridicule from people like Jamie Dimon, a brilliant misdirection that bought them time to build their own tools in the dark. Now, it has moved to execution with the development of superior financial weapons like bank issued deposit tokens. The grand blueprint is right there if you're willing to tokenize the assets, turning the world's wealth into digital instruments they control the rails by building their own highways on top of public blockchains, own the on-ramps, becoming the exclusive gatekeepers for big money, and finally, weaponize the collateral, re-centralizing the entire business of lending. This isn't just JP Morgan. It's an industry-wide pincer movement with Citi, BNY Mellon, HSBC, and dozens of others all marching in the same direction, helped by a regulatory climate that's being built just for them. The great irony is that the very technology designed to make banks obsolete is now being used by them to build a more efficient, powerful, and all encompassing version of the same old system. The dream of an open, permissionless financial world is fading, replaced by a hybrid system where Wall Street, not the crypto natives, holds all the power. They aren't joining the new system, they are absorbing it. The question is no longer if the banks are coming for crypto, they're already here. The real question we have to ask is, in this new world they're building, what's left of the original crypto dream? What is left of decentralization when the center becomes stronger than ever before? The lines have been drawn. The future of finance hangs in the balance, and it's looking more and more like it will belong to the very institutions it was supposed to overthrow. What do you think? Is this institutional embrace the ultimate bull case for crypto, or is it the end of decentralization as we know it? Let me know your thoughts in the comments below. Your perspective is a crucial part of this conversation. And if you want to stay ahead of these monumental shifts in finance, make sure you're subscribed with notifications on. Thanks for watching.